Hi, welcome back. Today we're going to talk about free cash flows. In fact, it's a testament to the times that it's been a long time since we've actually talked about free cash flows. But a market correction, like an impending execution, focuses the mind. When you think about losing your investment capital, all of a sudden you come back to your senses. Notice that there's been a lot less talk about growing users and subscribers and revenue growth and much more about earnings this year. A greater talk of free cash flows. Companies are talking about it. Investors are talking about it. Now, part of me feels vindicated. As an intrinsic value believer, I've always talked about cash flows. But I'm a little wary about this current talk about free cash flow because I'm not quite sure what people are talking about. In fact, I would argue that the first thing we need to do is nail down what we mean by free cash flow, because the definitions that are floating around boggle the mind. Second, we need to get some perspective. What do free cash flows look like? We have a sense of what earnings look like, but what do free cash flows look like? So with those missions in mind, let me start with free cash flow. I've often said in my classes that there is no more dangerous term in finance than free cash flow. Sounds like hyperbole, but the reason I say that is I've seen analysts use free cash flow to mean whatever they want it to mean. I've seen people say, look, if you add depreciation and amortization back to earnings, you get free cash flow. The fact that you've stopped at an intermediate stop doesn't seem to give them pause. Of course, in companies, especially young companies, have carried this to an art form with adjusted EBITDA. To begin with, EBITDA by itself is not a free cash flow. Why isn't it free? Because it's before taxes and before CapEx and before working capital needs. But even if you took EBITDA as a cash flow, the way these adjustments are made, again, push the limits of what free cash flow is supposed to measure. You'll see companies adding back stock-based compensation. Why? We'll come back and look at the logic, which actually makes no sense. But the point I'm trying to make is if you're in a debate with somebody about free cash flow, the first thing you need to nail down is whether your definition of free cash flow and their definition of free cash flow converges. So let's start by looking at what free cash flow is and how it's measured. Before you start to think about free cash flows, you need to specify to whom. You're saying, what are you talking about, to whom? If you think about a firm can raise capital from equity investors or from lenders. Whether it's a private or a public firm, there are only two ways you can raise capital. There are two ways you can define free cash flow. One is free cash flows to just equity investors. That's a cash flow left over after every other need has been met and debt payments have been covered. That's free cash flow to equity. But there's another measure of free cash flow that's floating around that sometimes confuses people. It's called free cash flow to the firm. Let me give you my intuitive understanding of what free cash flow to the firm is. Free cash flows to equity measure cash flows that equity investors get from the firm. Free cash flows to the firm measure the cash flows that both equity investors and lenders get from the firm. So what kind of cash flows do lenders get? Well, they get interest payments, they get debt repayments, and to the degree that you take on new debt, you might be able to offset some of those debt repayments. But it's cash flows to debt and cash flows to equity combined as a free cash flow to the firm. Now later we'll come back and talk about why we have two measures of free cash flow, but let's be clear, free cash flow to equity measures the cash flow left over for just the equity investors. Free cash flow to the firm is a pre-debt cash flow. It's a cash flow that all claim holders get. Let's talk mechanics. To estimate free cash flow to equity, here's what you start with. You start with earnings to equity investors, net income. Then you add back non-cash expenses, depreciation and amortization, the most common of those, but there might be other non-cash expenses. And then you subtract out what you put back into the firm. Completely discretionary. You can choose not to, but if you put money back into capital expenditures, cash acquisitions, and of course, if you invest money in working capital, your working capital increases, that change in non-cash working capital, the increase becomes a reduction in your cash flows. Net income, you add back depreciation and amortization, you subtract out CapEx, you subtract out change in working capital. You've come up with a measure of free cash flow before you factored in cash flows to and from debt. You see, what are you talking about? Well, if you repay debt, that's a cash outflow, so you need to net it out. And if you take on new debt, that's a cash inflow. The net debt cash flow, when you take it out of the free cash flow, gives you a free cash flow to equity for equity investors. I think of it as potential dividend. This is potential dividend because it's cash left over after you've met every conceivable need. Companies can choose to pay it out as a dividend, they can choose to buy back stock, or they can just choose to hold on to the cash and increase their cash balance. That's free cash flow to equity. What about free cash flow to the firm? Well, if you compare the free cash flow to the firm to free cash flow to equity calculations, noting that my starting point is different. Rather than start with net income, I start with operating income or earnings before interest and taxes. Now you can go accounting on me and finesse the two, but to me, the two are two expressions for the same number that you're trying to estimate. You start with operating income. Why? Because net income is after interest expenses and free cash flow to the firm, as we said, is cash flows before debt payments. So you start with operating income. Then you act like you pay taxes on that operating income. Notice the word I used, act. I know you don't pay taxes on operating income. You pay taxes on taxable income, but you act like you have no interest expenses and you're paying taxes on your operating income. It's a hypothetical tax. You net that tax out. You come up with after-tax operating income. Now, different services, different authors use different terms for it. McKinsey, for instance, called this NOPLAT. But it's after-tax operating income in whatever guise you decide to put it in. Then you subtract out exactly the same reinvestment we talked about in the free cash flow to equity context. You add back depreciation and amortization, you subtract out CapEx. In fact, CapEx minus depreciation I call net CapEx and change in working capital. That becomes the reinvestment. What you're left with is the free cash flow to the firm. Notice that there are no debt inflows and debt outflows because when you're looking at a pre-debt cash flows to and from debt don't get counted. You're saying, what does the free cash flow to the firm measure? At one level, it measures cash flows to all claim holders in the firm. Another way to think about the free cash flow to the firm is this is the cash flow you'd have had if you'd been an all equity funded company, if you've chosen not to borrow money. That's why some people call this an unlevered cash flow. But basically you're saying if I had no debt, what would my cash flows look like? Now with that structure, let's talk about using this to actually compute free cash flow to equity and free cash flow to the firm for a company. I'm going to use Microsoft as my example, and I'm using their 2021 fiscal year numbers to compute free cash flows to equity. Now, if you're computing free cash flows to equity, every number you need is on one financial statement. You know which one, right? Go to the statement of cash flows. Everything you need will be there. I'm going to use Microsoft's statement of cash flows to compute the free cash flow to equity. I'm going to start with net income. So right from the top, $61.271 billion. I'm going to add back depreciation and amortization, the $11,686 million that you see there. I'm also going to add back the gains that I showed on investments. That's a non-cash gain. So when you add back these expenses, you basically also have to add back any other non-cash items. And because I counted these gains and they're non-cash, I'm taking them out of the process. So the minus 1,249 is my removing gains because they're not cash gains. You're saying, what about stock-based compensation? I'm going to come back and talk a lot more about this. But to me, stock-based compensation is not a non-cash expense. It's not like depreciation and amortization. It's more of an in-kind expense. In other words, you're using equity to pay somebody. You've got to treat it very differently from depreciation. So I'm going to ignore it for my free cash flow to equity calculation. Then if you look at all of the other items below, all of these inside the box, those are all short-term items, accounts receivable, accounts payable. And if I consolidate them, I get a number of I basically get an increase in working capital of $1.086 billion. And when working capital goes up, it decreases cash flows. I'm subtracting out the $1.086 billion. So that takes care of the items in the operating cash flows. Let me move to the investing cash flows. There are two items in the investing cash flows I'm going to count in. The first is capital expenditures, because for obvious reason, that's a cash outflow, the additions to plant and equipment. But I'm also going to count in cash acquisitions. You're saying, but acquisitions are not CapEx. Says who? Acquisitions to me are gigantic CapEx. I net those out. I come up with free cash flows before I factored in debt repayments and debt issuances. At least in this period, all that Microsoft did was repaid $5.5 billion debt. It took on no new debt. So debt raised is zero. Debt repaid is $5.5 billion. You net that out. You come up with a free cash flow to equity after debt of 36,397 million. Now, actually, you can, if you find this too involved, too many calculations, I've taken all of the items from between the net income and the free cash flow equity prior to debt and consolidated them and called them reinvestment. So reinvestment includes net capex. Capex minus depreciation includes cash acquisitions, includes change in working capital. The nice thing about consolidating it, it basically allows you to tell a story about what Microsoft did in 2021. In 2021. It had net income of 61.2 billion. It reinvested 19.4 billion. It got free cash flow equity before debt of 41.9 billion. Debt removed 5.5 billion, leaving them with free cash flow equity after debt payments of 36.4 billion. That's a free cash flow equity calculation. Incidentally, there's one item here, this tiny foreign exchange item, which you can see jumps back and forth. I could have brought it in. It was just too small to even worry, to factor in. But if you have a foreign exchange item consistently showing up across time, you can also bring that into the free cash flow equity. So what about free cash flow to the firm? To compute free cash flow to the firm, I have to leave the statement of cash flows to get two items. One is operating income, which will be on the income statement. The other is an effective tax rate, which should also be in the income statement. For those of you who've forgotten effective tax rates, it's just the taxes payable divided by taxable income in the income statement. In 2021, Microsoft had an effective tax rate of 13.83%. Its operating income was 69.9 billion. So here's what I'm going to do. I'm going to act like I pay that effective tax rate on my operating income. Again, it's acting. I don't pay taxes on operating income. I'm going to act like I do. The taxes I get is 9.7 billion. I net that out. I get after-tax operating income of 60.2 billion. Then the reinvestment I subtract out is exactly the same reinvestment I talked about in the context of net income, 19.37 billion, which leaves me with a free cash flow to the firm of 40.9 billion. Since Microsoft is a company with relatively little debt, the free cash flow to equity and free cash flow to the firm are pretty close. Another way of presenting the numbers you saw on that page is in a waterfall chart. Basically, you start with your net income for free cash flow to equity, you net out the reinvestment, you net out the debt payment, you come up with free cash flow to equity. For free cash flow to the firm, you start with operating income, you net out the taxes you will have to pay hypothetically on that operating income and the reinvestment, you come up with free cash flow to the firm. So those are the mechanics. Let's talk about how free cash flows get used. There are three contexts in which you're going to see free cash flows used. One is to explain what happened last year. You're purely interested in explanatory power, which is what did the company do last year? So you're going to be able to use the free cash flows to see where cash came from and where it went. In fact, you're doing what accountants do in the statement of cash flows. The second use of free cash flow is in valuation, where you project out future free cash flows to be able to value business. The third place you're going to see free cash flows used is in pricing. You think, what does that mean? Well, you know how people price companies, right? They compute a pricing multiple, PE ratios, price to book, EV to EBITDA. They compare that across companies. How do free cash flows help? Rather than use price earnings ratios, you might use price to free cash flow to equity. For some reason, there are some analysts who somehow think using free cash flow will give them better pricing. We'll come back and see whether that's true. You're saying, why distinguish between the missions? Because the way you compute free cash flows can be very different depending on your mission. If your objective is to just explain the past, then you should stay with the past. So if you ask me what happened at Microsoft in 2021, I'm going to show you that table that I just showed with the actual cash flows in 2021. The acquisition they made, so essentially my objective is to explain what the company did in 2021. In fact, you can learn a great deal about the health of a company during a year by looking at its cash flows. So you've all seen accounting statements of cash flows. Accountants also try to do that, but their mission is very different. The statement of cash flows doesn't try to give you free cash flows to equity. It tries to explain what happened to cash during the course of the year. How much did the cash balance change? The information you need for free cash flows to equity is in there. So here's how I think about free cash flows to equity and how they're useful. Earlier, I described free cash flows to equity as potential dividend. I said this is what you can afford to pay out as a company. In the statement of cash flows, companies also report what they actually return to investors, either in dividends, regular or special, or in the form of stock buybacks. And if you have stock issuances, if you want, you can net them out against the buybacks. So potential dividends have actual cash returned. Now, you might find that rare company which pays out exactly what it could afford to every year. A residual cash flow policy. I don't think I've ever seen one that does this. For whatever reason, companies either pay too little or pay too much for the most part. In other words, some companies hold back cash. They return less cash than they have available as free cash to equity. Other companies return more cash than they can. And each has consequences. If the cash you return is less than your free cash flow equity, you have 100 million in free cash flow equity, you chose to return 70 million, that difference of 30 million, you know where it's going to go? Don't say retained earnings, wrong side of the balance sheet. It's going to go into your cash balance. A company that consistently returns less cash than it can afford to is going to build up a cash balance. Now, do you see how companies end up with 50, 100 or $200 billion cash balances? It's not manna from heaven. It's a direct consequence of year after year holding back cash you could have returned. You can also return more cash than you have available as free cash flow equity. If 100 million free cash flow equity, you might choose to return 120 million. Again, for good reasons or bad reasons. A good reason might be that your free cash flow equity jumps around. You're smoothing out what you return to reflect what you make in a typical year. So if you're a cyclical or a commodity company, you might smooth things out and return cash that's actually greater than your free cash flow equity in a down year and return less in an up year. It could also be there because you're involved in Me Tooism. What does that mean? You're paying dividends because everybody else is paying dividends. You're buying back stock because you've always bought back stock, or everybody else is buying back stock. If you return more than your free cash flow equity, you have a bit of a hole, right? And here's how you might fill the hole. If you have cash balances from past periods, you might use it to cover the difference. So in this example that I just gave, you return 120 million, you're only 100 million free cash flow equity. You can draw down your existing cash balance by 20 million. And if you have enough cash, you can do this for a long time. But if you return so much cash that you don't have enough in your cash balance to cover it, you know what you'll have to do? You'll have to raise fresh equity. That makes no sense, right? You say, why would I raise equity to pay dividends and buy back stock? Because you get locked into doing something and you're afraid to change it. So if you return more than you have available as free cash flow equity, either draw down the cash balance, issue new equity. Now, of course, there are some companies where the free cash flow equity is going to be negative. Why? Either because you're losing money or because you reinvested large amounts. Even if that company returns no cash, it's already in a deficit, right? So it has to do the same things. It either has to draw down an existing cash balance or raise new equity. We'll come back and talk a little bit more about that. In the context of free cash flow to the firm, remember, free cash flow to the firm is the cash flow you have available to service not just what equity investors need, but also what you've promised lenders. So from the free cash flow to the firm, the first claim is going to come from the lenders. You've got to make interest payments. And of course, you have to repay debt. You've got to repay the debt. You might raise fresh debt. So you cover debt cash flows. From the free cash flow of the firm, you also get the free cash flow equity that we talked about, from which you have dividends and buybacks. And of course, if you collectively return less cash than you have available to lenders and equity investors than you have available as free cash flow of the firm, again, you're going to see an increase in cash balance. If it's less than what you've returned, then of course your cash balance decreases, or you got to raise fresh capital from equity and debt. So there's an advantage to looking at the past, but there you're using a very strict definition of free cash flow equity and firm. You're looking at what happened that year. Now, when you talk about using free cash flows in valuation, your task is different, right? You might estimate the free cash flows from last year, but you're doing it not because you're interested in last year. It has no relevance to value today, but because you want a base year from which to build off your forecast for the future. It's a very different mission. So when you compute free cash flow equity and free cash flow of the firm for valuation, you're looking forward. You're saying, what should my base year look like so I get the best estimates for the future? A little bit of a tangent. You're saying, well, which one should I use when I do valuation? Depends again on whether you want to value just the equity in a firm, where you can take free cash flows to equity, project free cash flows to equity, and discount them at the cost of equity and value the equity. Or whether you're valuing the entire business, where you take free cash to the firm, but if that's a cash flow you're discounting, you're going to discount it back not at the cost of equity, but at a weighted average of your cost of equity and cost of debt, the cost of capital. And you'll come up with the value of the operating assets. Then you can add cash, subtract out debt, do all the cleaning up. But you got to make the choice up front. You can't just say free cash flow and not tell me which of these two approaches you're using. So let's talk a little bit about what you might do differently if you're computing free cash flow, either to equity or the firm, for a base year. Remember when you looked at last year's cash flows, there are items that you pulled off the statement of cash flows. In fact, one item you saw for Microsoft was a gain that they made, a one-time gain, which pushed up their income, but it was non-cash. Now that is an unusual item. It's not going to recur every year. So if you have unusual or one-time items, take them out of the calculation, because if you build them into the base year, you risk forecasting something that's not going to be there. Second, when we looked at 2021 numbers for Microsoft, we looked at the actual change in non-cash working capital, the actual CapEx, the actual cash acquisitions. But 2021 might have been an unusual year. Working capital is the most volatile of all items. Some years it goes up, some years it goes down. Using last year's change in working capital might give you a very bad indication of what's going to happen in the future. The case of Microsoft, one thing I think might be worth doing is replacing last year's change in working capital with some variant that's more normalized, smoothed out. I'm going to show you the variant that I'm going to use. If last year you had a big acquisition and you don't think the company is going to do it more than once every 4 or 5 years, again, you might have to normalize numbers. So when you're estimating free cash flows as a basis for forecasting, you have a lot more discretion in what you do to those numbers. Some numbers you might normalize, some you might leave as is, some you might remove altogether. Now let me talk about stock-based compensation. To me, one of the biggest malpractices in valuation is what we do with stock-based compensation. What companies do, what analysts do. Here's the logic they use. I'm trying to compute cash flows. Stock-based compensation is not a cash flow, so I'm going to add it back. That's convenient, but here's what it's missing. Let's assume I add back stock-based compensation. I'm going to increase my free cash flows to equity in the firm, right? And let's say I project out those future cash flows based on that higher base. Think of what I'm implicitly assuming. I'm implicitly assuming that I will not have to compensate employees in the future, because I'm acting like that compensation is not an expense. It's an in-kind expense. I'm giving a share of my equity. As an equity investor, it makes my equity less valuable if you keep doing that. And by the same logic, remember I added back cash-based acquisitions? Why just cash-based acquisitions? If you do an acquisition, you pay with shares, you're effectively using my equity. And if you plan to keep doing it, I want to build that in. So don't fall for the trick of adding back stock-based compensation and ignoring stock-based acquisitions. Treat them as if they're cash flows. On taxes, when I did Microsoft's free cash flow for the firm last year, I used the actual effective tax rate. But as we all know, tax rates swing around. They're high in some years, low in others. Using a year in which your tax rate is unusually low or high can give you a very misleading base from which to make forecasting. And finally, there is this issue of accountants being inconsistent about what they call operating expense and what they call CapEx. Let's face it, R&D is a CapEx, but accountants treat it as an operating expense. By itself, it doesn't change your free cash flow to equity, but it can change your views about how profitable your company is and how much it reinvests. Microsoft, for instance, in 2021, the fiscal year 2021, had $20.7 billion in R&D that was expensed. It lowered their net income, but in fact, it was one of the biggest capital expenditures. So just to show you what would be different if I were computing a free cash flow to equity for Microsoft for forecasting in valuation, as opposed to doing it just for last year to explain what they did last year. First, I would capitalize R&D. I've kind of used a shortcut. You added the entire R&D, but there's a little more involved exercise you'd go through. It will push up my net income when I do that. When I capitalize R&D, there will be an amortization to bring in. But here are the other changes I would make. Last year, working capital was actually a cash outflow. Why? Because working capital went up. That's unusual in Microsoft. Microsoft has a history of negative non-cash working capital. Whereas it grows, it actually becomes more negative. So here's what I did. Instead of using last year's change in working capital, I looked at working capital as a percentage of revenues over the last decade. It's minus 10.18%. And estimated what the change would have been last year based on that percentage. So what it does is it makes working capital go from being a cash outflow to a cash inflow, because that's the type of business Microsoft is in. Now for the CapEx, notice I've added the R&D. As I said, it's a very simplistic adjustment where I've added the R&D to both my net income and my CapEx. And that's why it doesn't affect my free cash flows. The net effect is zero. And for acquisitions, I've brought in both cash and stock-based acquisitions. So it's not just the cash acquisition. I've included an acquisition of a company called Nuance that Microsoft bought in 2021 for $19 billion plus, but paid for with stock. What I'm trying to say is the free cash flows to equity that I get with these normalized values is the base that I'm going to use to project out future cash flows. It's $21.6 billion, not the actual free cash flow to equity. If your question is, am I allowed to do all this stuff? When you're doing valuation, you get the discretion, the freedom to replace numbers that you don't think are numbers that you will see every year going forward. Finally, let's talk about pricing. As I said, in pricing, you scale the market price to something. So you can compare across companies. Price earnings ratios, you're scaling market price to net income. EV to EBITDA, you're scaling the enterprise value, which is the market value of operating assets, to EBITDA. Now, there are some analysts who argue that you shouldn't trust accounting earnings, and I don't trust accounting earnings, but they think instead of accounting earnings, it would be better to use free cash flow. I'm not so sure about that. But what they're arguing for, instead of using price earnings ratios, why don't we look at price to free cash flow to equity multiples? So if looking at EV to EBITDA, why don't we look at EV to free cash flow to the firm? It sounds reasonable, right? The logic is cash flows are better than earnings, and that logic sounds compelling. But we'll see in pricing, the logic doesn't always hold up because you're looking at last year's free cash flow to equity and last year's free cash flow to the firm. And the question is, are they better indicators how healthy and profitable your firm is? So let's get some perspective on free cash flow. What I have in this graph is one of my favorite, you've seen this before, a corporate life cycle, where I graph out what happens to companies over time. Startups, young companies, middle-aged companies, declining companies, dying companies. And what I've done here is looked at the items that go into free cash flow to equity at each stage. So let me cut to the chase. You should expect to see negative free cash flows to equity at young companies. Why? Because often you start with a loss. The business model is still evolving. You have huge reinvestments because you want to grow, and you take a loss and you put reinvestments in, you get huge negative free cash flows to equity. It's called cash burn. It's a feature, not a bug. And you cover it with equity issuances. Why? Because you don't have a cash balance available to cover those cash flows. As you grow and your business model takes form, you start to make money, but you will start to make money well before your free cash flow to equity turns positive. And here's why. You'll start to make money because you're growing. Your business model is evolving. But remember, you're still growing. You're reinvesting a lot. So often in the early years, your income can be positive, but your free cash flow to equity can continue to be negative. As your growth starts to level off, and that's the key, as your growth starts to become lower, your reinvestment needs drop off, your free cash flow to equity will turn positive, and it'll actually grow faster than your net income as a mature company. It'll level off when you become a mature company. And then when you go into decline, your earnings are going to decline much more quickly because in decline, you're shrinking as a company, you might divest your assets, you might actually have this strange phenomenon of free cash flows equity running ahead of earnings as you go into liquidation mode. You tell me where you are in the life cycle, I can kind of guess what kind of free cash flows to equity you should have. I'll use two things to illustrate this point. One is I've taken one of my favorite companies, Tesla, and graphed out their net income and free cash flow to equity every year since 2006. It's pretty much all the financial statement numbers I could find through 2021. We start with an obvious statement. Through much of its life, Tesla has been a money-losing company. Not because it's a bad company, but because it's a young, growing company with huge ambitions. Its free cash flows equity have been even more negative than its net income. It finally turned the corner on profitability in 2020. It started making money, but it still had negative free cash flow equity. In 2021, for the first time, net income was not only was net income positive, but so was free cash flow equity. If you're an optimist in Tesla, the good news is Tesla is growing up. The bad news is, if you've been ascribing growth rates of 60, 70, 80% of the company, it's time to stop. I mean, that is the downside of growing up, is your growth rates will start to level off. Now, if you look across companies, is there any evidence of this phenomenon? We talked about a free cash flows to equity changing as companies age. Here's what I did. I took all US companies and broke them down by age, from youngest to oldest, by decile. And then I looked at net income and free cash flow to equity for each of these companies. Start with a couple of things that jump out at you. Young firms are more likely to lose money than older firms. You shouldn't be surprised by that in both absolute and relative terms. Young companies are more likely to have negative free cash flows equity than older firms. So what you see here is, as companies age, their earnings and free cash flows equity go from negative to positive. It's the natural course of being. It doesn't make young companies bad and old companies good, but it does mean that if your investing is focused on big positive cash flows, you will end up with older, more mature companies in your portfolio. In fact, it does show up in what these companies actually return to investors. Now, if you go, in fact, on the previous page, there's a couple of things I want to point to. One is, if you look at the youngest companies, 73% of the youngest companies are money losing, 76% have negative free cash flows to equity. Those statistics improve as you mature, and you see that reflect in what companies returned. Young companies are the least likely to pay dividends. Only 15% pay dividends. Older companies, 75% pay dividends. Young companies buy back stock a lot less frequently than older companies. Why? Because they don't have the cash flows. In fact, I'm surprised that 23% of the youngest companies actually buy back stock. If you're trying to explain why some companies pay dividends and others don't, why some companies buy back stock, the answer lies in where they lie in the life cycle. Of course, some companies do dysfunctional things, but across, in the aggregate at least, it makes sense to expect companies that are young to pay out less in dividends and buy back less stock. We close with a very short discourse on pricing. Let's be clear about why people prefer to price companies and value them. Seems simpler, right? Dividing the price by the earnings per share to come up with the PE ratio is a lot easier than projecting out free cash flows equity for the next 10 years and a terminal value and valuing it today. People like pricing because it's simple. And people like pricing because of a frame of reference. What am I talking about? If I came to you with a stock with a PE ratio of 100, you're probably going to say, that's a high number, that's an expensive stock. Tell me why. Why? Because you have a frame of reference. Whether that frame is right or not, you're saying, well, I think 15 is an average. If I'm paying 25 or 30 times earnings, I'm paying more than I should. It's an expensive stock. So it's nice with pricing, a frame of reference allows you to make quick judgments. This is expensive, this is cheap. So when an LBO guy says, look, 6 times EBITDA is cheap, he's talking with a frame of reference. The problem with free cash flow multiples is, unlike PE ratios or EV to EBITDA, they haven't been around long enough. We haven't seen them often enough to have a frame of reference. The second is, earnings are noisy, right? Analysts accountants can move things around. But free cash flows are even noisier because you start with the noisy earnings and then you're putting in things like capex and acquisitions and working capital. What I'm trying to say is, sometimes free cash flows are a worse indicator of how well a company is doing than earnings are because of all of those additional adjustments. Let's fix the frame of reference though. You're saying, if I decide to use price to free cash flow equity, what do the numbers look like? Well, I've tried to help you out here. by taking all publicly traded firms, 48,788 companies in my sample, and computing P/E ratios and price to free cash flow equity for every firm. So let me start with the broad statistics. The median global company has a price-earnings ratio of about 17 and a price to free cash flow equity ratio of about 15.6. So I have the first, but the statistic that should jump out at you is that last row in that table. When I use price-earnings ratios for companies, out of the almost 49,000 companies, I lose 51% of my sample. You're saying, what do you mean lose? Remember when your earnings per share are negative, you can't compute P/E ratios? Well, more than half of all companies have negative earnings. And that's a bad thing because you start with a sample size of 30, you might lose 14 because they have negative earnings, and it creates a sampling bias in pricing. Well, it's even worse with price to free cash flow equity. 63% of companies have negative free cash flow equity. So not only do you have a weak frame of reference, but you're going to lose more firms in your sample when you use free cash flow equity multiples. I also did the same comparison with EV to EBITDA and EV to free cash flow of the firm. Here the levels are different. Remember, EBITDA is before taxes, before capex. Not surprisingly, EV to free cash flow of the firm numbers are going to be higher than EV to EBITDA. So if you're coming from a background of having used EV to EBITDA and you've shifted to EV to free cash flow of the firm, you can't carry your rules of thumb into EV to. So if you think 6 times EBITDA is cheap, and you're right, you can't use 6 times free cash flow of the firm being cheap because you should have a higher number, even if everything else holds. It's not like you don't have a missing company problem with these multiples, but you have less of a problem. With EV to EBITDA, you lose about 42% of your sample, either because EBITDA is negative or with segments like financial services, EBITDA cannot be even computed. With EV to free cash flow of the firm, you lose more again, about 55%. It sticks in my craw to even make this statement as a true believer in cash flows. But if you're going to be pricing things, maybe you're better off just staying with earnings, price-earnings ratio and EBITDA, than using free cash flow scale measures. Because I think a single year's free cash flow is less informative, more noisy than a single year's earnings. Now, of course, as a believer in intrinsic valuation, I would never want you to do things based on a single year's number, but that's what you're doing in pricing, right? But I do think that even if you use price-earnings ratio, EV to EBITDA, you can augment your pricing, make it better by bringing in things that you learn by looking at the free cash flow to equity and free cash flow to the firm. Like what? If you're looking at EV to EBITDA, it's a pre-tax number. I'd love to know what effective tax rate you paid. Higher effective tax rates will push down your EV to EBITDA multiple. I'd love to know how much you're reinvesting to get growth. The more you reinvest to get a given growth rate, you're being less efficient. I'd expect you to have a lower PE and a lower EV to EBITDA. And I'd also like to know what you're doing to deliver your growth. Are you doing it by adding debt? This should make me a little more worried if I'm looking at PE ratios to see a company delivering growth by increasing its debt ratio, especially if it's pushing it past a point it shouldn't be pushed past. Bottom line, there's nothing inherently better about a single year's free cash flow. But I think learning how to compute free cash flows and pushing back against these concocted measures like adjusted EBITDA is, I think, something we should all be thinking about. And I hope you found this session useful. And thank you very much for listening. Take care.